Why do pairs trading work? The fact is that the two time series which we choose should be co-integrated with each other. The concept of co-integration was introduced by the Nobel laureate Sir Clive Granger in 1981, and it means that a one-time series relative to the other goes in a certain range and is always returning to the point of intersection. In order to better understand co-integration in pairs trading, we will resort to a slightly adapted version of the story, The Drunk and His Dog, by Michael Murray, first published in 1994. Imagine that during the night, a drunk customer sets out from the pub and starts wandering in the streets. His movement trajectory is similar to a random walk, and it is quite difficult to predict exactly where he is going on his way, and what will be his end destination. Such movement trajectory can be called non-stationary. The drunkard is accompanied by his dog, which always keeps track of the drunk's position. Whenever the drunk moves away, the dog will speed up to close the gap. Whenever the drunk approaches too close, the dog will tend to widen the in-between distance. James and Barry, two regular customers, look outside the pub's window and bet on the drunk's and the dog's position. They observe the drunk and the dog individually, but their course looks no different than a random walk. Suddenly, Gary throws the idea, well, it's all a matter of finding the drunk. The dog should be around. He is right, because no matter how far apart the two fellows may currently be, their course will soon converge. It means that the distance between two paths is stationary, and the walks of the drunk and the dog are co-integrated. James and Barry eventually agree to play the following game. Why not bet on their relative distance rather than their absolute positions? It's called pairs trading. The pairs trading strategy is based on the concept of relative pricing. If two securities have identical payoffs in all states, their prices should be identical. This is a variant of the principle commonly referred to as the law of one price. Lamont and Thaler define the LOP as follows. Identical goods must have identical prices. It is important to note that the prices do not need to be correct from an economical point of view for the LOP to be valid. The LOP simply asserts that stocks yielding identical payoffs should have the same current price. The law is therefore applicable to the relative pricing of the stocks in a market, even if the pricing is economically incorrect. We can further extend the example with identical payoffs to a situation where the payoffs are very similar but not identical. In such a situation, the prices of the securities should also be similar. If a temporary deviation from this relative pricing relationship occurs, it should be possible to exploit this by taking a position that generates a profit when the deviation is corrected. Pairs trading is one example of a strategy aiming to profit from such temporary deviations.